All right, guys, let's quickly take a look at tomorrow morning's flash PMI data. Now, for those of you who've been following the videos for a while, you'll know that, Eurozone flash PMI data is probably one of my favorite indicators. I've had so many really good trades out of this over the years. It's really one of my favorites. However, like I mentioned on Monday, there's a little bit of additional risk this week because unlike the other things we normally focus on, like the economy, like positioning, like the ECB, like sentiment, etc., there's a whole different idiosyncratic thing in play for the euro right now, which is, of course, this chart, which is the political situation, right? That massive blowout that we had in the peripheral spreads as well as the OAT Bund spread, that's been one of the key drivers for the euro from last week. So that poses both good news and bad news for tomorrow's print. Let's start with the bad news. The bad news is that because the markets are so focused on the political situation, we probably don't want to be pushing our luck by trading anything more than a scalp out of the data. It means that, if it wasn't for the political situation, we could have potentially looked to trade like we have or have been looking to trade over the past few months, looking for big upside surprises to trade the euro higher with. This time around, we won't be looking for any long, medium term or swing-based trades, if you will. We'll only be looking for scalps because we don't know how fast the markets will discount whatever data we get and turn the attention back to the politics. So whether we get a good beat or a bad miss, the markets might discount either one of those very quickly and say, yeah, okay, fine, it's a good number or it's a bad number, but we're not focused on that right now. The good news out of this is that for the first time in, what's it been now, 4 or 5 months, this whole political shenanigans does mean that we have the best shot compared to, like I said, I think the last 4 months to actually trade this both ways. Meaning that if we get a really good number, we can look for some upside. But if we get a really bad number, we can look for some downside. Remember, over the course of the last 4 months or so, we've only been trading or only been wanting to trade the euro higher if we got a beat in the data. We weren't interested to short it on bad data. The reason for that was because there was just way too much bad news priced for the euro. I mean, if we go to the positioning data, you guys will recall, a couple of months ago, it was massively stretched to the downside, that euro positioning. We have just inched closer towards the 20 percentile again, but we are nowhere near as stretched as we were a couple of weeks ago. Here we go. So when we only wanted to look for longs, it was when the euro positioning was massively stretched to the downside and the markets at the time was just pricing in way too much negatives, while the economic data was actually starting to surprise to the upside, looking at things like the City Economic Surprise Index, as you guys would recall. So what makes this slightly different is that for the first time in quite a while, we might actually be able to trade this both ways because of this geopolitical or political situation, because it has added some stress onto the euro. So if we give the markets, because the markets already negative it based on the political stuff, if we give it more reasons to be more negative, like bad data, that could see some short-term shorting opportunities played out for the euro. So bad news is short-term trades only. Good news is we might be able to trade this both ways. Regardless of whether we get a good or a bad number, I will be reducing my risk on these trades tomorrow. It's just been an incredibly messy week. We've got thinner liquidity and lower volumes with US participants away, with Juneteenth yesterday, obviously, and I'm expecting a lot of participants to just take this as a long weekend because it's such a messy week, because we don't have any major US data points, because it's quad witching as well. It's just a very crazy, messy week, which means that in a week like this, especially with the idiosyncratic political stuff in the background, I'm going to be dropping the risk way down when I trade this tomorrow, if we obviously get a trade for it. So with that out of the way, let's quickly take a look at the numbers. It's always important to remember when you look at things like PMIs, the flash PMIs specifically, that we don't get them released at the same time. We get the French data released at 8:50 in UK, then the German data released at 8:30, then the Eurozone total data released at 9, and at 9:30 we get the UK flash PMI data. Now, why that's important to understand is, firstly though, let's touch on the Eurozone composite number. These three numbers you can probably ignore. We normally don't pay attention to these because by the time that we've had both the French and the German data released, the markets already has a very good idea of where these numbers will land. So for example, if we get a big miss across the board for the French and the German data, there's a very high likelihood that the Eurozone total numbers will see the same miss. If these are a massive beat, it's a very high likelihood that these will see a massive beat. Also, by the time that we've had the French and the German data collected, that already gives us close to 40-45% of Eurozone GDP. So it's these three numbers are not really important. For a tradable opportunity, we are only looking at the French and the German data. Now, they are released staggered, like we said. French data first, then the German data. So the problem that you always face when you trade something out of the French data, assuming you get a massive miss or a massive beat, is that your trades that you get into out of the French data will always be in jeopardy as we wait for the German data, right? So let's just say we get a huge beat and we trade the euro higher on the back of the French data. There's always the risk that 15 minutes later we get the German data and it shows us the exact opposite, a massive miss across the board. If this was a miss, this is a massive beat. You know, if you have that type of thing, you need to get out of that French trade that you got into very quickly if the German data doesn't correspond to that French data. Now, there's some very, very nuanced times and contexts where you might actually get away with trading one even if the other one doesn't correspond. But I'm not going to confuse you guys by going through those types of examples now. When we have them, we'll obviously go through them. Just know that there are some times when those types of things could be allowed. But where we are now, we're not looking for that. We're just looking for a very plain miss and a beat across the board. So whatever we get into with the French data needs to be backed up by the German data. That also means that, you know, if we get the French data out, but it's like more mixed, let's say it's more flat or in line with expectations, then if you don't have any trades running on the French data, you might be able to squeeze out a trade here and there if the German data then comes out massively strong or massively weak. So there's two ways you can look at it. You either jump in on French data if it's good or bad enough, but then you're at risk for the German data. If that comes in different, then you have to close the trade. Alternatively, you don't get into anything in the French data, and the German data potentially gives you a trade. Now, the best case scenario, of course, is that you get a massive miss or beat across the board for the French data, and then your German data follows through and shows you the exact same beat or miss. Those are the perfect opportunities to trade. When this is massively bad and that's massively bad, or this is massively good and this is massively good, that's the perfect scenario. That's what you want to trade. What you don't want is you don't want to see, for example, flash manufacturing, super hot, services, super bad, or vice versa. Between these two, your services number is always going to be the slightly more important one. So you might have some cases where you have your flash coming in line with expectations, but then your services number comes in really bad or really good. Those could actually still be tradable, but you want the other number, the flash one, the manufacturing one, then to come in pretty close to estimates. You don't want to see it bad and then this one good. You can trade those if it's flat for the manufacturing and then a big beat or a big miss for the services. And that's just, you know, one nuance to keep in mind. And also between these two, the German data is always the more important data. It's just because it's such the far bigger share, obviously, of GDP. It's considered the more important economy between the two. So it would have been better if we got the German data out first always, but you know, that's just not how it works, unfortunately. So we'll need to deal with it as it comes, but just know that the German data tends to carry a little bit more weight, and between the three measures, the flash, the services, the composite, the most important one is the services, then the flash manufacturing. The composite is basically just the average between the services and the manufacturing. So that one matters, but it doesn't matter as much as the other two. So with all of that out of the way, how can we potentially look to trade this tomorrow? Like I said, preferably, I would still like to trade the euro higher on good data as opposed to trading it lower on bad data, just because the markets aren't as dovish as they were on the ECB just a couple of weeks ago. I do think that we are very close to a potential, peak pessimism when it comes to the risk aspect. If you take a look at, let me quickly bring this on the screen here. If you take a look at euro pair implied volatility, I mean, it feels like the markets are realizing that, hey, you know what, maybe we've priced in a little bit too much risk in a short space of time. So I'd still prefer that, but because we have this whole political situation in mind, we could look for some short-term shorts if the data is bad enough. So what type of data, what type of numbers are we looking for? I've always found that when we are trading PMI data, specifically the flash ones, anything below the minimum or above the maximum normally does the trick, right? So for a massive miss, we'll be looking for obviously a move below the consensus, but normally a move below the minimum or above the maximum should do the trick. When it comes to PMI data though, what you always want to include into your analysis is that magic 50 number, right? Anything below 50 normally shows us industry contraction, while anything above 50 shows us industry expansion. So for example, let's take the manufacturing flash for France. Maximum expectation is 48. So if we print 49, that's already very good, right? Because it's above consensus, it's above the max, it's above the prior. So if we print like 49, that'll be great. But if we can print 50 or just above 50, even better, right? Because that shows us that we are moving out of contractionary territory and into expansionary territory. So for all of these numbers, again, if we get 49, that'll still be fine. But the closer we get to 50, and if we can get a 5 handle on that, it's just so much better. Same story with let's take the services. There you can see that the minimum expectation is 49.5. So anything below that will be very bad, but it'll be even worse, right, if we print below 50, because that means we are printing into contractionary territory. So even though below 49.5 will be great, anything below 50 will already be bad because it's moving into contractionary territory. So for the most part, we'll be looking for a move below the minimum or above the maximum, and preferably we'll be looking for those psychological shifts in the data, going from a 4 handle to a 5 handle, or from a 5 handle to a 4 handle. That can be very meaningful for the markets when we have those types of shifts. So in terms of trading this, first data, French data. If that comes in with a massive miss or a massive beat across the board, I'll be looking to get into trades on the back of that. Like I said, the risk with that is you need to watch the German data. If the German data disagrees with that, you probably want to close that trade. Alternatively, if it comes in line, you just have a nice tailwind for that trade that you got into out of the French data. Alternatively, the French data gives us a dud. We don't do anything with it, and then the German data gives us a possible trade, which is sometimes even better, because then you don't have a lot to worry about after the German data. But those are the two possible scenarios we can take for the Eurozone data. Now, in terms of trading it, it's obvious that if it's a massive miss, we'll be looking for Euro downside. If it's a massive beat, we'll be looking for Euro upside. What to trade against the euro in either case? I think today's SNB decision has pretty much given us our counter trade we want to trade, right? Euro Swiss longs. I think that's the most obvious one to look for tomorrow on the back of the SNB decision. It's been a very messy decision, in my opinion. I'm not sure what the bank's end goal is right now based on that, because for me, there's a lot of things that didn't make sense, but you can't deny the momentum, right? The momentum is very bearish right now. The markets took it bearish. As long as the Swiss franc looks like this tomorrow, there could be some upside if the Eurozone data comes in really, really good. If you don't like trading the Swiss franc tomorrow on the back of that, well, the second weakest one is the yen. I'm not going to try and, force euro yen higher. The third weakest one is sterling. So everybody's favorite, euro sterling. If we get a super, super hot number, I'll be looking for a possible gap fill on euro sterling. Really, really simple. Nothing more than that. But a gap fill back up to 84.90 could do the trick. The one key risk when it comes to trading euro sterling out of the Eurozone data is that after the Eurozone data at 9:30 UK, where is my time? Here we go. 9:30 UK, we get the UK data. So the big risk that you have is that even if you get a nice hot print out of these, you might trade euro sterling higher, but you need to be very cognizant that half an hour after the German or an hour after the German data, you get the UK data. So if this comes in really hot and you buy euro sterling and then the UK data comes in really hot, you want to preferably be at break even and have taken some profit off the table by the time that the UK data prints. Otherwise, you risk being run over by the UK data if it comes in the opposite, or in the same direction, if you will, as the Eurozone data. So just keep that in mind. But euro sterling long, again, it's something that always works nice, or majority of the time works nice as a differential play with the data. Again, this time might be slightly different. Just keep that political stuff in mind. But euro sterling upside as a gap fill looks plausible, and euro Swiss upside looks plausible as well. Numbers to look for: 96 flat, I think is the next magnet, and then above that would be that 96.22 level. Obviously, we'll have updated implied vol levels at the time, so that's obviously worth watching. But those pairs would be my favorites for tomorrow. What about a huge miss? What if we get a massive miss in the data? I think there's two pairs we can look at. The first one would be Euro CAD. The CAD has seen quite a decent amount of strength, and is only due to positioning right now. Look at the CAD today. It's the strongest currency in the session. It's the one we wanted to trade against the Swiss franc, or that I would have wanted to trade against the Swiss franc if I got into it. I of course didn't, but the CAD has been playing out the way that we anticipated so far this week by finding a bit of strength. And I think it's all down to positioning being unwound. I mean, that positioning got just ridiculously stretched, right? So not surprised at all to see that. So EuroCAD downside could be on the cards if we get some bad data on the euro. Potentially a move back down towards that 146.50. I mean, that's the next key level of support. That would make a lot of sense. If that cracks maybe the low, going back to the second, comes in at 146.40. I don't think we can squeeze out more than that on a Friday, but maybe 146 could be a possible pivot to aim for as well. But that looks a little bit far to me. But anyway, those are the levels we can look for. Euro CAD. The other one could be Euro Kiwi. I mean, we had some slightly better than expected Kiwi data. That doesn't really change anything on the fundamental side, but it does stick to the RBNZ's recent more hawkish shift, right? If growth isn't collapsing like banks like ANZ expect, at least in the short term, then that just leaves everything unchanged and it leaves the RBNZ hawkish. So some potential downside. We have seen the currency push up today, basically trading very much in line with the Aussie. If you don't like the Kiwi, you can probably go for the Euro Aussie, but the Aussie gives me the heebie-jeebies right now. I don't trust the move after the RBA. It doesn't make a lot of sense in my view. So I'll be rather choosing something like Euro Kiwi over Aussie. And there we've got some pretty huge levels here. I mean, if you go back to Feb, we've got that whole cluster of support coming in at that 174.50. And then below that at the 174 level, you've got a huge level as well. Massive support going back to December last year, January. Massive support going back to basically a couple of sessions ago. So key support here to the downside. Two very key levels to aim for as well if we get a huge miss in that Eurozone data. Now, what about the UK data? In terms of the UK data, I only want to trade this one way, and that is down if it's a massive miss. The reason for that is this week's data in terms of CPI hasn't changed anything for the Bank of England. They are still on track to cut rates. Today's decision that we had from the bank, I don't think that changes anything for the markets right now for sterling either. I think cuts are still on the way. There was that slight change in terms of the, as noted by the BBC, that slight shift in tone, suggesting that for those who voted hold, it was a more finely balanced decision, which might mean that if we didn't have an election to worry about, maybe they would have opted to vote for a cut today. Maybe we would have gotten that 5-4 vote split, which would have been very, very dovish. But the markets have taken that more bearish. We have seen sterling push lower. So I will only be open to short sterling if the data comes in really, really bad. Obviously, below the minimum will be fantastic, but the more we can get below 50, the better. We also have the retail sales data coming up, but look, retail sales can be market moving, but retail sales on the UK side is one of the least tradable data points for the UK. It's extremely noisy. The market tends to discount it very, very quickly. So even if it does come in very bad, which will be the only way that I would look to, look to take advantage of it if I was going to, it needs to be a massive miss only. Not going to look for it as a beat, but even if it is a massive miss, I'll just use that to tee up any type of trades out of the Eurozone data. I don't think retail sales will be something that I'll be interested to trade tomorrow. Let's see the numbers. If we print massively bad, maybe, but take a look at how bad we printed last time round, and the pound just shrugged it off so quickly. There was no reaction out of it. So be very careful with that retail sales data. Now, don't hate me tomorrow if for the first time in many months, retail sales actually does pack a punch. There's always the risk that that happens, right? Maybe the data comes in really bad and sterling just sells off aggressively on the back of it. Maybe that's the trigger. If that does happen, though, it's not going to be anticipated by anybody, right? So just watch the retail sales data, but the PMIs would be more attractive to trade based on the recent way that we've seen the data move. So in terms of UK data, only be interested there to short it if it's a massive miss. What can we look to trade against it? Well, again, we get the French data and German data first. So if this comes in super strong, I'll potentially be in a euro sterling long anyway. Then I would be hoping / praying that the UK data comes in really, really bad. If it does, then I'll just be holding on to the euro sterling trade, right? Then you don't have to, I'm not going to add to it, but I'll just be riding the move higher if that happens. Alternatively, the other thing we could consider, I'm not super excited about it, but where is my chart? Let me just quickly. Here it is, man. Pound CAD. It's not going to be. The reason why I say I'm not super excited about it is it's not a fundamental trade. It's like the Euro CAD. It's just going to be purely tactical. But I mean, take a look at this. Take a look at this technicals. We are moving up to a monster level of support here around that let's just call it 173.50-ish. Below that, there's a lot of room to cover to the downside if we see some serious, position squaring taking place in the likes of the CAD. So pound CAD could be interesting. Again, not excited about it from a fundamental point of view. It's really just tactical. And there's always the risk that this short-term strength we see in the CAD today, we might not see it tomorrow. So just, watch it. Again, it's not one that I'm very excited about, but it is a possible one that we can look at if we get some bad enough data coming out for the UK data. All right, so that's a preview. It's a little bit more lengthy than usual, but we've got a lot of data points to cover, obviously, and we'll do the US data in tomorrow's session. So good luck trading it. Let's hope we get some real big deviations to make some money from it.